My name is Kelli Schrade. I'm the Director of Manager Research at Marquette. I promise I'm not doing a Donald Trump impression here, but you will see me taking a sip of water from time to time. It probably won't get the media attention that it could, but it's true. Professional women do get colds from time to time. So I might be coughing from time. These kids, they go to school, they infect you instead of themselves. So, all right, I'm thrilled to present our next topic, which is the changing landscape of active management for U.S. equities. And our agenda for today highlights a topic I know is on the minds of many of you. Given the recent underperformance of active managers, Jim talked about this extensively, is U.S. active management dead? And we're going to explore this question and whether structural changes in the stock market are the main reasons for this underperformance. We'll also investigate the small cap premium, typically an area where active managers have added value, but whether that is a myth. And finally, we'll offer some insight on what investors should do and some takeaways for you to consider at your board meetings going forward. So let's get started. What is going on with active managers these days? Why aren't they doing better? So the headlines paint a grim picture, right? Active asset managers knocked by shift to passive strategies. 86% of active equity funds underperform. No brain indexers beat active managers again. And life's too short to hunt down a decent active fund manager. That's my favorite because I've spent the entirety of my 20-year career looking for good active managers. Okay, so fund flows, this chart shows fund flows, show that many investors, they're just throwing in the towel on active managers. This is the asset flows of all U.S. equity mutual funds over the past 10 years. Red bar, index products, blue bar, active funds. Look at those last 2 years. Asset flows have turned negative for active funds. More and more money pouring into index products. $420 billion over the last 18 months has been invested in index funds. Why has the trend favored indexing? Performance, performance, performance. These charts look at the percentage of active managers who beat their respective benchmark over the 10-year annualized period. So we looked at two things. Managers on the left, this is 2006. On the right, 2016. And what is startling here, over the past decade, active managers, particularly on the growth side, have been pretty gosh darn awful. I would use some stronger language, but it's a family event, okay? Pretty gosh darn awful. I'm going to point to large growth specifically. Back in 2006, 99% of active large growth managers outperformed the index on a 10-year annualized basis. You could throw a dart at a dartboard and find a manager who outperformed. I looked really smart back then. Today, that story is much different. Just 16% of active large growth managers have outperformed the Russell 1000 growth on a trailing 10-year basis. So you might look at these charts, you might see a silver lining. Well, wait a second, those value managers seem to do okay. Large value went from 53% of managers outperforming back in 2006 to 71% today. Well, that's improvement, right? Well, not so fast. We took this analysis further and looked at performance net of fees. And once we calculate fees into the picture, the numbers take a darker turn. You can see on the far right here, only small core and small value managers eke above the 50% mark, meaning that half of the active managers in those asset classes, net of fees, beat their benchmarks. Large value, previous chart I told you 71% outperformed, is slashed to just 35% when fees are considered. So bottom line here is very clear. Fees matter. So given that backdrop, can active managers, this is my homage to Muhammad Ali, can active managers recover from this stark picture, or have index products delivered the knockout punch? So let's explore this topic. Has the US market changed structurally. So Jim argued that he thought this was cyclical. But is it structural, making it harder or even impossible for most US active managers to outperform? So we're going to go back in time for a minute. Anyone remember this? I'm kind of glad I don't have to wear that to work, but the shoes are pretty cool. Okay, this is when stocks were literally delivered on a ticker tape and then posted on a board. If you look really closely, you can actually see some companies that still exist today, like GE. This is the G's. This was fun to explain to the millennials, by the way. What? What's a ticker tape? So we've come a long way, right? Technology has changed the landscape of the stock market and stock analysis. And this slide takes us through a timeline of some important inventions for us finance folks. Invention of spreadsheets in the 1970s. What's important here is that there's no shortage of stock information today. There's one estimate that the average investor can access, this is a crazy statistic, can access the equivalent of 174 newspapers. 174 newspapers. That's the equivalent of the information we're exposed to on each and every day. And that's an astounding concept considering our rapid 24/7 media-centric world today. What does this mean in the 21st century? With information literally at our fingertips, amazing technological advances. You know, we can carry, here's my Marquette phone, right? We carry computers in our pockets, okay? Why are active managers struggling so badly? I'm going to offer 4 main reasons. There are less IPOs, there are low volume levels, it's a highly regulated market, and electronic trading. So let's start with IPOs. This chart shows the number of IPOs coming to market since 1980. And if you look at this, you can see a huge spike in the 1990s tech boom, and then fairly low numbers since. I would argue this is one of the main reasons you see dismal numbers from growth managers. IPOs tend to be a veritable feeding frenzy, an all-you-can-eat buffet for growth managers. And it helps them outperform. With less IPOs coming to market, it isn't surprising growth managers' performance has suffered as well. Now, another market trend we examined was overall volume. This chart looks at the S&P 500 volume since 1990. And you see a large trend upwards throughout the 90s, primarily as new mutual funds exploded onto the marketplace, and then a drop-off since then. The ramifications of this are crowded trades and problems with liquidity. And some investors blame financial regulation for the poor volume, saying it has restricted trading activity by the major banks. And indeed, regulation has changed our industry. A big change since 2000 is regulation fair disclosure, aka Reg FD. This affects all active managers, and the playing field is a lot more level today. Beginning in 2000, the SEC implemented Reg FD, which prohibits company management, many of you know this, from selectively disclosing material non-public information. So when I started my career in the 1990s, the heyday of the tech bubble, sometimes I miss those days, investment managers, they could literally call up a company's CEO, ask them how the quarter was going, ask them about a rumored transaction, and there was nothing technically wrong with that CEO giving out that information to select investors. Today, the landscape is very different. Company managements take this regulation seriously, and this once competitive advantage is largely gone for active managers. This is not going to change unless the regulation changes, but let's say this is law. It's not going to change. Represents a large structural change over the past 16 years. So I'm going to give you something to look forward to with all this doom and gloom. How about a silver lining? Who is doing well despite all these headwinds? Quant funds. This chart looks at the performance difference between fundamental, the kick your tires managers, and quant managers. This is the 1, 3, 5, and 7-year annualized periods. We got large, mid, and small. This is the whole kit and caboodle. Quant funds have been able to outperform their fundamental competitors. Why would this be? Quant managers who survived the financial crisis, they argue they have built more adaptable models, and they further take better advantage of electronic trading in today's marketplace. And as we've talked about, the amount of data readily available has grown exponentially over the past decade, and they feel they are better able to capture an alpha premium. Now we're going to talk about demographic changes, or switch gears for a second, within the US and that effect on the stock market. So first, my colleague Jeremy Zarin will explore millennials and their habits further in the next session. But millennials are a force simply by their size. So looking at their investing habits, at least so far, shows a big difference from their baby boomer parents. If you look at this chart, millennials are more likely to rely on their employee-sponsored retirement plan. This is the greenish yellow bar on the far left, and not invest as much on their own, especially if you look at those far right bars, especially in individual stocks. So, most pressing issue with millennials is misplaced expectations about investing. A recent survey showed 32% think they need to save less than $300,000 for retirement. So while they are investing in their 401k plan, they simply aren't saving enough. How much will they need? It's $1 million. They need at least $1 million for retirement. So it's likely that the lack of millennial investing is also affecting the US equity markets. Baby boomers are retiring. They're pulling money out of equities. Those investments are not being readily replaced by millennials. So now let's shift gears from the macro to an asset class specific discussion. One asset class that many professional investors point to as an area where active managers add value, small cap, and particularly small value. So we're going to explore whether the small cap value premium is a myth. All right, let's look at this chart. It shows the rolling cumulative 20-year return spread between small caps and large caps. That's the premium small cap has offered over a long time horizon. So when the idea of the small cap premium first came into vogue, that was back in 1981 with Rolf Baines' paper, that premium was robust. If you were to annualize the 20-year return at that point, small cap held a 4% advantage over large caps. Think about that. That's 400 basis points over a 20-year period. It's pretty astounding. Then what happened? The premium started to dissipate. And while it's still there, it's by no means as dominant as it once was. Notice the circle on that far right. Post-financial crisis, that small cap premium has dwindled to just 1.8%. So the answer, the small cap premium is not a myth. It's still there, but it's not as prominent. The secret has been out. So if the small cap premium has dissipated, what about the value premium? In this chart, you can see the 20-year cumulative rolling return of HML. So let's untangle that acronym. That's stocks with high, the H, book to market value, minus stocks with low, the L, book to market value. Basically, this is the spread in return between value and growth stocks, okay? So in 1992, the year Fama and French debuted their groundbreaking three-factor model, touting the outperformance of value stocks, the value premium was generally strong and dominant. But now, that arrow shows the trend has been downward. So while the value premium is still present, like the small cap premium, it is nowhere near as prevalent as it once was. Alpha here has become much more scarce. Okay, so what an interesting trend. The idea that there are too many cooks in the kitchen. The number of new CFA charter holders has exploded over the last 3 decades. This chart shows the number of charters awarded each calendar year. And today, there are nearly 130,000 CFA charter holders. Last year, 220,000 people registered to take one of the CFA's 3 exams. Man, that is a lot of number 2 pencils. So what this means is that more and more skilled investors are competing for alpha, and limited alpha at that. So what should you do? So to succeed in the 21st century, I will offer 3 potential paths. The first is to evaluate different types of strategies, perhaps ones that you haven't considered before. A few to mention: factor-based and smart beta strategies. Now, both of these come in different forms, and they might not be appropriate for everyone, and whatever other disclaimers some lawyer will tell me to say. But the basic concept is to bucket different risks, like volatility. Smart beta, in particular, is often used as an alternative to index strategies. Gives investors the ability to capture specific investment risks, such as dividends. The second idea is that active managers will adapt and evolve to these changing conditions. Business fundamentals like earnings still matter, but perhaps they will matter differently going forward. For example, earnings growth. Talk a lot about earnings growth with managers. That may take on more importance in a low growth or no growth economic backdrop. And the last is to use active managers differently, perhaps with a core index allocation and then a satellite approach with active management for your various plans. So I'll leave you with a couple key thoughts. First, avoid closet indexers. You want your active managers to be active. Look for managers willing to be different than the index. Next, focus on long-term performance and avoid short-term bias. Look, I know focusing on the long term can be hard, especially when looking at point-in-time returns in your quarterly reports. I'd offer to consider using rolling returns instead to evaluate active managers. You know, due diligence today is even more important. People matter. Understanding a manager's strategy is even more critical, especially as alpha becomes scarce. And finally, low fees are always important. You don't always get what you pay for in asset management. It's not a car, right? Study after study shows the importance of low fees for long-term success. If there's one data point I'd encourage all of you to turn to first when evaluating an active manager, it's the fee structure. So with that, I'm going to end my comments. I'm going to ask my colleague, Jeremy Zarin, who we affectionately call Jay-Z. So Jay-Z is going to come up, different version of Jay-Z. And he's going to talk about, he's going to educate us on the millennials, a different kind of creature, and the demographics of real estate investing. Thank you.